I think Europe has been set to outperform for about 20 years, right? And
that's exactly why I'm asking you the question.
It hasn't really done that. So I think as we look into next year, again, I think the prospects are okay, but as ever for Europe, it's all about the stocks. So I think it's very difficult to make a sort of meta overview argument for Europe. You spend time talking about France, the political uncertainties that are sitting in there. But we do think that at the company level, there remain some really attractive opportunities that have the potential to deliver as good returns as you can find anywhere else in the world. And so when we're looking to our European allocation within portfolios, we expect that piece to do at least as well as anything else that we can put money into. But you do have to be selective.
Yeah, so tell us where, what geographies, sectors, where do you think those opportunities are?
And again, I think it's probably not completely dissimilar. We continue to think technology looks pretty good. Europe is more overweight to software. Software's had a pretty tough time over the last couple of years. We've been in a sort of capex restriction. Companies have been cautious in terms of spending. So we see companies like Sage, perhaps Dassault, SAP continuing to do quite well. Those would be the sort of places. Again, within the semiconductor space, we continue to like ASML, but also perhaps sort of more niche companies like Bessie, which provide the packaging services that help to basically put more processing power into microchips. And those are the things which we continue to see looking pretty good. So you're going to have to be selective, but we do see some good opportunities, and we do see a rebound coming through in software, which will be more positive for European stocks.
I want to talk mining, but before we get there, I just would like to clarify your thoughts on European banking names, because obviously we are at a point where the ECB is continuing the lowering interest rates, but at the same time we are seeing a little bit more of an interest in terms of consolidation for the sector. So ultimately, what is the outlook? Is perhaps more consolidation going to support European banking names, or is more pressure coming from the fact that we're going to have lower rates?
I think it's going to have to be more selective, I think. When you're looking at that sector, I think still valuations are pretty low, which is going to be supportive, but you're going to have a differentiation, I think, in terms of earnings delivery. And typically those lower multiple sectors do still trade on earnings momentum. And you've seen quite a variance in terms of delivery over the course of the last couple of years. Everyone's benefited from higher rates, but some areas have benefited more, particularly the Southern European banks, and those that have been perceived to have less, I guess, sort of political risk exposure as well. So, within the banking space, we would continue to think that Italy, Spain still look pretty good, lowish multiples, and probably more insulated against what will probably likely be a declining interest rate environment next year.
Interesting. Let's talk mining then. You're saying in your notes that there's exciting opportunities in future minerals and so on. Just outline for us the outlook here. Why do you think there's an opportunity? And perhaps give us your thoughts also on Rio Tinto specifically, if you can, given that this week we have heard the comments from an activist investor suggesting that they should actually delist from London. Try to put it all together for us.
Yeah, maybe if we come to Rio, I mean, again, I'm pretty cynical, to be honest, about whether or not your listing domicile is really going to make that much difference. If you think about global capital flows, is it really the case that investors have not noticed that a particular company in a particular market should trade much less than if it was simply listed in another market? I'm not necessarily sure that that's the case. I think when we look at a lot of multiple differentiation, it's coming because companies just aren't as good as companies in other markets, and that's also been quite a big driver. So I'd just be a little cautious about that. I know that there can be some elements around taxation which might perhaps improve the prospects for a listing in Australia versus London, but again would say to the company, don't see that as some sort of panacea that's going to cure your multiple at the current time. You've got to think long term. I think in terms of the mining space, it's kind of been an area, if you think about sort of net zero, decarbonization, electrification, in a lot of ways, those have been elements that have kind of been pushed to the side as we've moved through this year. I think particularly with the result in the US election, with the recessionary environment we've seen in China, it's been quite a tough environment for minerals prices. And we've seen, some very weak commodities in that space. We think that this, given the longer term structural drivers are still intact, and we continue to see very strong demand pictures, particularly in areas like copper, we think that pullback from $10,000 down to around 9,000 presents an interesting opportunity. And we still see much more demand into the midterm than we see supply.